Hello everybody. Alright, so if you have seen my videos, you would know I talk a lot about a very specific model that I use. And I use this every day. But in this video, what I want to do is go back to Thursday's trade, which is the 12th of Feb, and I want to replace one element from the model. And that is, instead of using fair value gaps, I'm going to use the fixed range profile or the fixed volume profile. So my model has three steps. I call it the two-step model. So the model is called a two-step model. I used to call it the fib model. So if you watch older videos, you'll hear me say fib model. It's the same thing. So it's the two-step model. And the reason it's called a two-step model is because it really is two steps. We're looking for a direction. So I'm just going to draw this out. Okay, see, it goes down. We wait for a retracement, and then we simply profit. We are looking for a measured move. This is why it's called the two-step model. So I didn't invent the two-step. I got it from a book, and I mentioned the book I actually got it from in some of the videos. I just adapted it. So in the two-step model, we have three steps. So three steps I follow every single day. The first is identifying direction. So here I have ES and I go to the 5 minutes. So you guys know I always use the 5 minutes. This is my operational time frame. And what I'm actually going to do is let's do a replay on this one. So I'm just going to remove this. We're going back to Thursday's trade. I'm just going to go somewhere here. Okay. So step one of my model is we wait. So I wait 30 to 40 minutes after the market open to get direction. So 9:30, so this is ES, it's 5 minutes, 9:30. We wait 30 minutes. This green box is your 30 minutes, give or take. So I look at price in time boxes of 30 minutes. So 30 minutes, 1 hour, 1 hour, 30 minutes, etc. I also break down my time box into half, right? 15 minutes. So it can be 45 minutes, for example. This is why I say I wait 30 to 45 minutes to get the direction. What I mean is I need a swing high on the 5 minutes and a swing low. Without the swing high and swing low, I don't have a direction. If I don't have a direction, I cannot move to step two of the model. So we have on Thursday's trading 5 minutes. I only use the 5 minutes. Yes, you can use other time frames, but just based on my experience, I stick with the 5 minutes. And I explain in some videos why I do this. Yes, you will miss trades. So now I have direction. Now let's go to step two. Okay, and let's talk about the volume profile, the fixed range volume profile. In step two, what I usually do, always do actually, is I look for a 5 minute fair value gap inside that directional range. Now in this range, you can see there is no obvious 5 minute fair value gap, either on the other side of the range or inside this range, right? Completely sealed. Now this trade actually played out on the 15 minutes, and I mentioned in multiple videos that this can happen, but that's the way the model is designed. You're not going to get every trade. But if you stick to one time frame, you build muscle memory on that specific time frame. That is why I stick to the 5 minutes. But the intention of this video is I'm actually going to replace the fair value gap in step two with my uh, volume profile. Okay, So I'm going to use the fixed range volume profile. In step 2, what am I going to do? Now, fixed range volume profile has a lot of strategies. Okay, it can get really complicated. I'm going to simplify this. I'm going to grab my fixed range volume profile, 5 minutes. I'm going to tap the high of my directional range and push it down to the low of that directional range. That's all I'm going to do. So the high, the swing high, where you have a lower high to the left and lower high to the right, swing low, a higher low to the right, to the left, a higher low to the right. Okay. And all I'm going to use is the point of control, nothing else, not the fair value area, just the point of control, this red line, because that's potentially the place with the most activity. Buyers, sellers, who else? Everybody. So I'm replacing fair value gaps with a fixed range volume profile. And I'm going to do exactly the same thing I do. So now what I'm doing is moving to step 3 of the two-step model, which is I'm also going to add on my fib from the high to the low. And what I'm looking for is the point of control to overlap with a fib. What does it do here? Overlaps to that 30 fib. Okay, nice and neat. Okay, so we have the 3 steps: direction, fixed range, volume profile, which I've replaced with a fair value gap. So I replaced that, took away the fair value gap. Step 3 is just overlap. And the reason you have the overlap is you're looking for a confluence, right? And the standard is 3, but I only use 2. So now I'm using the fibs and the fixed range volume profile, but I'm just using the point of control. I'm not using the high, the low, just the point of control. Once price retraces into that point of control and your fib, that is where you take your trade. You notice how price on the 5 minutes never closes beyond that 30 fib. Yes, it can wick. You have to be aware of the wicks, but that's where you're taking your trade. Now, at this point, it comes down to experience. At that point of control, you are anticipating to take a trade. So now you can drop down to the 1 minute if you want and look for a more precise trade, or you can enter your trade inside that zone as soon as price goes in that zone and anticipate that your stop loss is going to be above this high initially, this up candle above that high. Okay, because that's your fair value area high. So you put it initially there. What are we targeting? Well, it's 100% of the move. It's 100%. It's a measured move. So you take your fib, you run it up until the point where it goes to high. It goes quite high, but it's a wick. It can happen. So again, you can go down to the 1 minute to be more precise, but I just want to stick with the 5 minutes. Your stop loss above there, okay, gets close, but doesn't. You're not going to win every trade. And this is your target, right? It's 100% of the move. So this level here is what you're targeting. Put a line there. Okay, that's what you're targeting. So if we play it, we can see clearly we get there very quickly. And that is it. So same model, and this is the reason I call it a framework, not rules, because personally, if you watch my videos, you know I hate rules. I can't stick to rules. So I mentally told myself, right, what I'm going to do instead is build it as a framework. In other words, I can take any element from each step and replace them with something else. And I talked a lot about the direction and how I establish direction, what I look for, and some of the elements inside that. Now I'm talking about the fair value gap, step two, and how I've literally replaced the fair value gap with a fixed range volume profile, just using the point of control. The rest is experience. It's just experience. Do you have at the point of control support? Is prices being supported? Do you see a rejection? At that point, you can drop down to a lower time frame or just stick with the 5 minutes. Do you get a rejection off the 5 minutes? Put your stop loss at a reasonable distance, and then you target a measured move. That's it. So same model. All I've done is in this video replaced it with a fixed range volume profile. Now, I don't use the fixed. I used to use the fixed range volume profile, but I just simplified it by replacing it with a fair value gap. Because to me, it's the same thing. Yes, I know that technical people who will say it's not, but a fair value gap works the same way and it's visually easier to see and easier to track. So this is the reason my model uses the fair value gap instead of the fixed range volume profile. But there you have it, folks. Hopefully you found something interesting. I will see you in the next video.